Hello and good morning, listeners. We believe Almus Market Mornings did really become a part of your morning routine with the regular dose of wonderful insights from our richly experienced experts, Mr. Jairam and Mr. Pankaj. We take pride in publishing 629 episodes diligently every operational day from the past 3 years. This week, we look to carry out a small experiment, bringing in another very well experienced expert from our team, delivering the similar financial markets insights, just slightly different. To introduce Ankit, he's been here with the market for more than a decade and is an integral figure here at Almus. Glad to have you here, Ankit. Eager to listen to your narrative of the financial markets.
Thank you, Swaraj, for the introduction. Let me come out clean upfront that I have been a USD bull since US started raising rates a couple of years back. Even though the dollar index has retraced from its previous peak of 115 to 105 odd currently, I continue to believe that the forex market is somewhere, or the forex market is somewhere in the middle of the US USD cyclical bull market. Let's understand this in a bit of a detail. The global growth is not only a function of a rising economic activity, but it also a function of rising money supply in the market. The more the money supply, the more demand for the goods and services. Since 2008, US has had strings of economic easy policy. We had seen Q1, Q2, Q3, Q10 in the past 15, 17 years. Whenever US Fed eases, USD falls, and this pushes global asset prices higher. The two times when the Fed tightened during this period, namely in 2013-14 and in 2022 recently, we saw USD rising massively, giving goosebumps to central banks and forex traders globally. Coming to the current scenario, that we are all aware that the US debt is more than 115% or so of their GDP. Their economy is currently around 28 trillion and their debt is 33 trillion. You'll be amazed to know that US adds almost USD 1 trillion to its debt only because of the rise in the interest rates. Not in the not US is not in the situation that it can borrow endlessly. If not stop, they have to bring down their borrowing program dramatically. We traders will have more clarity on this once US elections are over in November and new government takes shape. I also assume that the interest rates shall not come down as much anytime soon. Some people call it the end of the dollar supremacy. But I look at it from a different point of view. See, the US interest rates are not coming down. Um, the US interest rates are not coming down much, and the US would slow their borrowing program. This will make dollar less available in the market. So less supply, the price goes up. Therefore, I expect dollar to remain elevated for many weeks and months ahead. This is the broad theme, or you can say a bias that I have for the dollar. Coming to the near term, global currencies have been in a broad range, as we all know, for the past many months. I attribute this to the fact that most of the countries, especially the US, are going on elections this year. No big fund or financial institution, to my understanding, is likely to place big bets on the directional move in this election season. I continue to expect this range in the forex markets to continue for some more time. Finally, considering the above factors, I expect rupee also to remain in a range of 83.20-25 on the lower side, with a possibility to retest 83.70-75 in the coming days. There are no clear signs of a directional move emerging as of now in INR, and traders should wait for range tops and bottoms to initiate hedges.
Thank you, Ankit. And that was a very interesting narrative, especially when you said that interest rates are not expected to come down. Even in yesterday's Federal Reserve meeting, Powell reiterated a similar sentiment that interest rates they are not seeing any evidence of inflation coming down, and so hence no reason to cut rates as of now. We will continue to build on this narrative as more data comes along. Thank you so much, Ankit, for being here, and we'll catch up with all of you with the latest round of financial updates tomorrow. Thank you.